UPS stock, ticker symbol UPS. This stock is up 5.8% year to date, underperforming the S&P 500 by a decent margin. From a dividend point of view, things look pretty interesting with dividend yield at 3.5%. And take a look at the 5-year growth rate, almost 13%, which is a great number. On the 25th of April, UPS presented quarter results where they missed on both the EPS and revenue. For the upcoming earnings, all analysts voted a miss, which is very interesting. When the company announced the earnings, it fell down from a year-to-date high to, in the end, a year-to-date low. So could this be the perfect moment to buy UPS stock, or did we miss the boat already? Well, I'm very excited to see what you guys think about the stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does UPS do? As the world's largest parcel delivery company, UPS manages a massive fleet of more than 500 planes and 100,000 vehicles, along with many hundreds of sorting facilities, to deliver an average of about 25 million packages per day to residents and businesses across the globe. When we dive in the most recent earnings report, we see that UPS reported a revenue of 22.9 billion, down 6% year over year, which is not looking that good of course. But keep in mind that this is highly impacted by people ordering less stuff online and in general because of inflation. What worries me a bit more is the adjusted operating profit and operating margin. Both are down big time, which is of course something that I don't like. EPS is down 27.9% year over year, which is also not looking good to me. In here we see the average daily volume for the US domestic segment. It's going down 5.4% year over year, which is not a good thing. Revenue went down only 0.9% and revenue per piece grew 4.8%, which is very interesting. Combination of base rates and customer mix and fuel drove the growth rate. However, even with these results, adjusted operating profit and profit margin went down quite a bit. The international segment is down even more in daily volume, 9.5% in total. Revenue was down 6.8% year over year, which does really hurt to see. But what worries me even more again is the operating profit and margin, both being down big time. The supply chain segment is also down in total revenue, 22.5% year over year. And again, operating profit and operating margin are down big time. For the 2023 full year outlook, UPS expects to deliver a revenue around 97 billion, with an operating margin of around 12.8%. Dividend payout of 5.4 billion and share repurchases of 3 billion, which is looking really good. For the US segment, they expect to see a 3% decline in daily volume, and for the international segment it's expected to see a 4% decline. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. UPS is a 159 billion market cap company. PE ratio is at 14.8, which could indicate that they are undervalued right now. Later in this video I will show you my 3 price targets for UPS stock, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 98 billion and in this graph we see that revenue went up kinda nice and steady. However, most recently revenue started to decrease, which is something that is happening industry-wide right now. We see the same thing happening at FedEx. Over a longer period of time, margins are going up and down quite a bit, but in the long run it is increasing, especially in the past couple of years. And with revenue slowing down, it's really important to have a steady and increasing margin. EPS is also going up and down quite a bit, following the margin and revenue, but again it's going up in the long run. Analysts expect EPS to decline roughly 12% in 2023, which of course does hurt to see. However, after 2023 they expect to see high single-digit growth, which is very nice. For the revenue it is pretty similar pattern, with a decline in 2023, but after that revenue is going up low to mid single digits, which is fine in my opinion. It is a massive company, so you can't expect high numbers here. Return on assets is sitting at 9.4%, which is a decent number. Return on equity looks really good, and the most important number here, return on invested capital, is sitting at 18.5%, which is a great number. Unfortunately, it is lower than the 5-year average, so that is something to keep your eye on. Current ratio is at 1.34, which looks pretty good to me. Over a longer period of time it is really steady and even decreasing, which is not a bad thing. Total debt is sitting at 26 billion, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now total cash is sitting at roughly 9.4 billion, so they can't pay down a big chunk of their total debt, which is something that I really like. But it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run. But it is not really steady and consistent, so again keep an eye on this number as well. A thing that I love about this company are the shares outstanding. It's going down in the long run. It means when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 3.5%, which is a decent number. Annual payout is at $6.48 and payout ratio is at 51%. I prefer 50% or lower, so right now they have 49% left in cash to buy back shares, pay down debt, do acquisitions and a lot of things. The 5-year growth rate is at almost 13%, which is also a great number, and one of the reasons why I love this stock so much. On top of that, they increased the dividends for 13 years in a row. And if you take a look at these numbers, the dividends paid since 2010, you see that UPS really likes to increase the dividends, which is very nice. In 2022 they did this massive increase of 50%, which attracted a lot of new investors. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. In here we see that over a longer period of time, payout ratio is kinda steady, except for the lockdown periods, which makes sense of course. In this graph we see the expected dividends in 2023, 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It is expected to grow at historical growth numbers, which is very nice. Overall these dividends look pretty good to me, but how about the historical returns? I decided to compare UPS stock with the overall market, in this case the S&P 500. Next to that I added their main competitor, which is FedEx. On the 5-year chart we see that UPS beats the S&P 500 with 92% including dividends, versus 76% for the S&P 500. UPS also crushed FedEx big time. On the 1-year chart it looks pretty different, with FedEx returning 23% versus the S&P 500 returning 21%. UPS has only a 7% return. On the 6-month chart it is pretty much the same story again. FedEx is beating the S&P 500 and UPS by a significant amount. On the 1-month chart it is again FedEx that is having the highest return with 12%. Both UPS and the S&P 500 are seeing a 3% return. So bottom line, UPS beats the S&P 500 and FedEx in the long run. But most recently it doesn't look anything like that. So is UPS stock a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with the revenue growth. For the revenue growth I'm filling in 3, 4 and 5%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 9, 10 and 11%. And for the free cash flow margin I'm putting in 8, 9 and 10. For the PE ratio and price to free cash flow I'm filling in 15, 16 and 17. It is the industry leading company that is still capable of growing, but I don't want to overpay for the growth. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, UPS stock is at $185. I hit analyze, and we only see one green number. We have a low price target of $111 to $125, which is a big drop from the current stock price. We have a mid-price target of $138 to $154, which is still a big drop from the current stock price. And we have a high price target of $171 to $188. To me, the mid to high price target is the most justified here, indicating that the stock is overvalued right now. And to be honest, I'm focusing on the range of $160 to $190. My final conclusion is that I really like this company. It is a massive company that is still capable of growing the business. Most fundamentals look good, aside from the short-term problems with revenue and margin, of course. I do think the company will do great in the long run, and I can't wait for the stock price to come down again. With the upcoming earnings being a major impact in my opinion, since all analysts expect a miss, and to be honest, I think they will miss the earnings as well, which could lead to a big decline in the stock price. From a value point of view, I think we need to wait before buying. Right now it doesn't feel like the right time, but from a dividend point of view things look pretty interesting with this high dividend yield and growth. For now I'm just waiting for the next earnings report, and I will analyze them from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.